Hi everyone, Ali here on April 14th, 2020. And I guess the question that everyone has is that is this rally for real, right? And over the past few days, I've been really thinking and reading and listening and watching a lot of things, trying to come up with genuine reasons to back up this rally. So first of all, a lot of companies, and this is, there are a lot of hedge funds out there that have hedges for their long positions, and when those hedges become profitable with such a drop in the market over a short period of time, then a lot of people who are short, they're going to start covering, and generally most of the recoveries start with short covering, right? The next thing is that there over the years there has been a lot of cash on the sidelines, so people are seeing this as an opportunity and jumping in. Then there's a rubber band effect that you can only pull the rubber band on to such an extent, and then it's going to come back. The next one is fear of missing out. So when the market starts rebounding, then people start fearing that okay, they might miss out, and then they start jumping the bandwagon. And then so all these are like behavioral finance things. And then there are other factors like what the Federal Reserve is doing. So the Federal Reserve is out there buying debt and providing liquidity to the market. I'm not going to complicate it any further. Bottom line, they're providing a lot of liquidity to the market. And when people are going to exit, selling those bonds to the Fed, that money has to flow somewhere else. And the quickest and the easiest is equities market. And then, everyone knows about the government stimulus and the paycheck protection plan that they have, and other things that the government is doing, the loans, and so on and so forth. Then there's another notion that all the bad news and the expectation what's going to happen over the next quarter or 2 quarters, and how the companies are going to face the shortage of demand and stuff, that has all been priced in. Then social distancing is working and the mortality rate is dropping. And then finally, the idea that there is a strong consumer demand that's building up, and then as soon as we open up the economy, there'll be a rebound. So with all these expectations and all these reasons, the market's been going up, right? But on the flip side, and anyone who's been questioning the rally, they already know these things, that why are people not trusting this rally? Because week over week we're seeing the unemployment numbers growing, and that's another reason for the rally, that the places where, because the US is more of a service industry, a lot of people are sitting at home working, whether you're in IT, whether you're a lawyer, whether you're an accountant. A lot of people can easily do the same functionality or the work that they're doing from home. It's unfortunate that a lot of people who are working at malls and restaurants, and you know they are being furloughed or they are being let go, but the portion of the economy, unfortunately, those people are very small. But nevertheless, it's unemployment, and it is going to take a toll on either the rental market or housing, and so on and so forth. Um, then all these things could create permanent damage. So let's say if there are businesses that are at the brink of shutting down, they might shut down. And people who were really thinking of starting a new business, they might hold off and they might say, okay, you know what, let me just hold on to my capital, and they might wait until everything clears up. So there might be some permanent damage done along the way. Then over time, with the unemployment and everything, the consumer is going to weaken. There are some sectors that are weaker than others, right? So we know that there is real problem with retail, with energy, like oil and gas sector. Um, with the drop in oil prices, then all this is going to impact real estate, and all of that is going to impact financial industry. And then, with all of this, industrials are going to be impacted. So, there are some sectors that have a lot of risk with what's going on than other sectors, right? So technology, healthcare, they're going to be booming. But there are other sectors that are going to be lagging, or will do have fair amount of risk, and that's all going to lead up to bankruptcies. And we are also hearing horrifying news from like IMF and other, ex Federal Reserve chairmen like Bernanke and Yellen, talking about like a really deep or sharp recession. So with all that, let's just look at the market, and then I'll share with you what I'm doing. Overall, we can see that the trend for NASDAQ, and I've shown this to you in the past, that over long term, the trend's positive, right? Obviously, in the screen, you're not seeing the 2008 financial crisis and also the dot-com bubble, but in both those cases, the S&P 500 fell roughly 50%, and what we saw is down like 35-40%. So, but it's not over yet, and I've already talked about the reasons for the rally, and S&P 500 rallying as well. And so that was the big picture. But zooming in, Nasdaq, and I have mentioned before that Nasdaq being tech and biotech heavy, you can see that there is a nice channel up. I've in the past I've drawn this box over here showing that when we break this box, it should go higher. In my other videos, I've talked about moving averages and them curving upwards. And when we go up and we find resistance at the 20-day moving average or any moving average, and we pull back and we find this higher low, we form these higher lows. Those are generally positive signs. And then following this, there's a crossover of 10-day crossing the 20-day, and then there's a big spike and a bounce, and this is forming this channel. And today we broke this channel and we close above the 50-day moving average. So, from a technical perspective, again, all good signs. If I were to look for, I had drawn like a bearish, like a rising wedge pattern over here, and it broke it. But over here now, it's more like a channel. But today we broke it. It would have been healthier if we pulled back or consolidated for a little longer and then moved higher. But we can only follow what the market is doing. We can't really dictate what the market is doing. S&P 500, a little different story, because as I said earlier about the different sectors being troubled, they are in S&P 500, not in Nasdaq. A lot of like energy and real estate and industrials, financials, like a lot of them are part of S&P 500, not part of Nasdaq 100. And similar trend over here, but we're seeing not a channel, but now this is again sort of building that rising wedge. So let's see if we cross this 50-day upwards, or we resist over here and then sort of consolidate or pull back. But so this would be interesting to see how far we pull back, or how long we consolidate. Consolidation would be a healthier uh, preposition over here. Then I just wanted to show you this bigger picture, and I've shown you this before as well, where most of these sectors were in red even on the 50-day, but now you can see that some of these sectors, or like the indices, are in green even above the 200-day moving average. So Nasdaq 100 is above the 200-day moving average. It's down only 11% from its all-time high. S&P and Dow Jones, you can see on the other hand, are still far below the 200-day moving average. And then again, you can see over here that XLK, um, which is a technology ETF, is above the 50 and the 200, and so is healthcare above the 50 and the 200. But everything else is below the 200-day moving average. And we can see that, energy being hit the hardest, um, financial energy like 20, still like 50% from its all-time high. Financials are 27% from all-time high. Industrials, which has airlines and other heavy machinery or Boeing, it's down 26% um, from its all-time high. So clearly we are seeing that technology and healthcare are leading this recovery, and other sectors are still lagging and falling behind. So those are the things to see if you want to pick up ETFs or stocks. So what am I doing? First of all, I am uh, deviating a little bit from the stocks, but I'm making sure that I have short-term liquidity. We don't know how the jobs are going to be, how the job environment is going to be. People do get laid off, right? So I personally feel that everyone should have short-term liquidity, and at least you can survive at least 1 year. Uh, so that's my goal. The next thing is for my retirement accounts, I am not stopping my biweekly contributions. They're still going on. Like in my retirement accounts, I only keep everything in equities, and I have um, S&P 500 and a growth fund, only two funds, and that's where all my contributions are going. And then I have been picking up, and this is my focus, that if I'm going to pick up ETFs, then they're going to be only in selective sectors. Obviously, with the risk and the drop in value, it does present an opportunity that you can buy those, and then you can maybe trade up and make money over time. But obviously with that there is risk. So always keep in mind risk reward ratio. And I'm gonna, maybe in my following video someday, I'm gonna cover like four key aspects of investing, and I'll cover that. So sector focus on winning sectors, not troubled sectors. That's one of my focus. And then I do like individual stocks as well, but I, because of my company requirement, I really can't pick them up that easily. But if they become really attractive, I might take that plunge. But when picking up stocks, my focus is, first thing is balance sheet. Um, I look for low debt to equity ratio. I don't want too much debt on their balance sheet, and I like to good cash balance. I mean, they could be investing, so it might not be growing cash balance, but this is the main focus on the balance sheet. The next thing, and rising equity, right? So the equity should be going up year over year, income statement, revenue and earnings growth year over year, and then cash flow. One of the key things that I like to look at, there is a line called cash flow from operations, and I like to see that the amount of cash flow generated year over year, it should be increasing. Then dry powder means you should have some, uh, whatever you're investing, whether your retirement account, 401k, or even if you've opened up a brokerage account. Like for me, I don't have a brokerage account yet, at least, but uh, keep some dry powder so you can keep buying in whatever you like, and if things do get cheaper. And then finally, I just wanted to touch on this, that when you're taking risk, just keep in mind, Delta, American, both did file for bankruptcy back in 2005 and 2011. Any company that files for bankruptcy doesn't mean that they're just going to, wipe out from the face of this earth. That means that the equity holders, let's say you as shareholder, your money is going to be wiped out. And then whatever the remaining company is, then the debt holders are going to own that remaining company. So just wanted to touch on this and make sure that people understand that uh, we've seen bankruptcies in the past, but how come these companies survive? That means you as a shareholder is going to lose everything, and the debt holders are going to own those companies. So with that, I wish you guys all the best and happy trading. Bye.